All right, welcome everybody.
Let's give everybody a minute or two.
Yeah, we're gonna give everybody a minute or two. Let me check with Lauren. Are people in? Oh, here we go.
Yeah.
Great. Okay, everybody. Sorry about that. We just had a technical difficulty for a second. Thank you all for joining the webinar on the Patterson Court Apartments. This is a 384 unit deal that we're buying off market in Orlando, Florida. It's across the street from the main entrance to Disney World. So we're extremely excited about it. The property was built in 2008 exclusively for Disney. So it was built to a higher spec that what is typical in the market. So in our opinion, it's an irreplaceable asset. Sorry, 1 second. So there we go. Okay, apologize for that. So my name is Andrew Lucas. I'm the director of capital markets here at Tryon. I handle the majority of our investor relations and capital raising. So for those of you who are familiar with us, we've probably had a conversation or at least traded some emails. Marley Dominguez, he joined Tryon about a year ago. He oversees our acquisitions in the Southeast. He went to college in the Southeast. He's previously worked for the Abu Dhabi royal family and the Kuwaiti pension fund. So he's acquired over $1 billion of multifamily properties in that region. And then we also have our fearless leader sitting to my right, Max Sharkansky. He is our co-founder and managing partner. So Max actually relocated to Miami about 6 months ago, and him and Marley are really spearheading our entrance into the Southeast. So I know many of you on the call are familiar with Tryon, but we have quite a few that this is our first interaction with them. So I won't bore you to death, but do want to give some overview of who we are. We were founded in 2006. We've acquired, by the end of this year, it'll be over $1 billion of properties. And coming out of the downturn, we did buy some office and some retail, but really over the past couple of years, we've created this kind of institutional philosophy that we will solely focus on multifamily properties. So we will do deals with different risk profiles. We'll do some core plus deals. We do some ground up construction in Los Angeles, but overwhelmingly, the majority of the deals we buy have some real value add component, some story to them as to why we're extremely confident that a vertically integrated group like us can come in on day one and really drive value. And we have a really strong track record. We've been around, again, 15 years. We are kind of unique in that while we have that track record, we still are a young group. You know, we're in our early 40s, late 30s, so we have quite a bit of runway ahead of us. And historically, we've been able to achieve really strong returns for our investors, over 30% when you take an average of all of the deals. We've done 80 plus deals, 40 round trip. And we're not targeting those type of returns in this environment. You know, some of those were coming out of the downturn when there was a lot of opportunistic deals in the market. But we're conservatively targeting high teens in this particular deal, low 20s investor IRRs. And we offer, so this specific opportunity, we're offering the ability to invest directly into this asset. We also offer a fund model, which spreads your investments over a pool of properties. So about 3 months ago, we launched the Tryon Multifamily Opportunity Fund 3. And that fund is investing, making a sizable investment into this property. This is its third investment. We're under contract on a fourth property, which is an $82 million deal in a really nice pocket of Denver. So for those of you who may be looking to make their first investment in commercial real estate or naturally may be a bit more risk adverse, the fund may be a good option for that because it just mitigates your risk by spreading it over a pool of assets. So with that, I'm going to turn it over to Marley. Again, Marley's our director of acquisitions. He's really the guy closest to the deal, and he can give you an overview on the property. And then at the end, if you do have questions, please post them in the chat room. At the conclusion of the presentation, we'll go through and answer as many questions as you can. And then Frank, our marketing director, will be posting the information request link in the chat room. So any of you guys who have not already requested access to the deal data room, you can do so by clicking that link. Those of you who have requested access, at the conclusion of the webinar, we will begin accepting investments. So you will receive an email from me inviting you to subscribe to the offering. So with that, Marley, take it away.
Thanks, Andrew. As Andrew mentioned, I lead the Southeast acquisitions for Tryon. And about a month ago, we were very excited to come into contract on this property, Patterson Court, located in the I-Drive corridor of Orlando. I-Drive, just for background, is probably the most populated submarket within Orlando. It's very close to Disney. It's close to the airport. It's very geographically well located. And because of Disney, because of some of the office parks around there, it's just historically been one of the more well-developed areas, submarkets of Orlando. And it's considered one of the blue chip submarkets. The asset itself, Patterson Court, was built in 2008. It was built for Disney. Disney has a variety of programs where they house interns and seasonal workers, both just to staff the theme park, but also to perform and do a variety of things throughout the year. And so they provide the housing for these seasonal workers. And this is one of those properties. Disney is very keen to make sure that these properties are done to a very high spec, but they also have a variety of different requirements that eventually leave us with a property that is, in our opinion, irreplaceable. It would never make economic sense to build a property to these specs in 2021. So what do I mean by that? As far as the interiors of the units, because they had it set up more as a roommate situation, every bedroom is almost treated like its own suite. Every single bedroom has a walk-in closet. Every single bedroom has its own bathroom, and each bedroom is quite large. The layouts are fantastic. The balconies are huge. The parking ratio is 2.34, which is about 900 spots, which is far, far above what you would find in any multifamily property. There's actually 1.1 parking spaces per bedroom, which I don't believe I've ever seen. The amenity spaces themselves the square footage of the clubhouse is tremendous. The reason for this was because they needed to have a variety of training rooms, screening rooms, and practice rooms for the various interns and staff that were living at the property. To be quite honest, we were really excited as we were touring comps, we basically realized that we could put every amenity that every comp has combined into our property, essentially. So there's just really a lot of special things that we can do there. So Disney started their master lease in 2008. It was a 10-year lease originally with 3 5-year extensions. They're in their second extension, which they did in 2018. That ends April 2023. They've already vacated the property. And the reason why they've done this, and they vacated they had a few properties in the submarket. They vacated them all over the last 5 years or so. The reason for this is because they're beginning to build their own properties that they own on their own land on the other side of the resort. So nothing to do with the property, just simply more of a structural change, a strategy change with the company. They have brought on Lincoln Property Management to sublease this property. There's 384 units, and they were able to lease this property in about 7 weeks. They did do that at 25% below market because they wanted to get the income in there as soon as possible. But to lease that many units in 7 weeks is, again, just gives you an indication of how nice the property is in its existing condition and how strong the submarket is as well. It should be worth noting that the lease is a triple net lease. So they have a headline rent, which today is $5.825 million, which based upon our purchase price represents about a 5.5 cap, which is of course outstanding in this market. But they also are responsible for all expenses. This even includes real estate taxes, insurance, really the whole 9 yards. So Lincoln that they brought in to lease up the property for the remaining term of their master lease is also their expense. So the 5.825 million is that they pay in headline rent is net to us during the first 18 months of ownership. Some other unique things about the property: it's 50% 3 bedrooms and 3 baths, which are very hard to find in the market. They are also very desirable in the market. We actually had trouble at times finding a 3 bedroom, 2 bath even that was available to understand the, or sorry, to understand the rents. The 3 bedrooms are the highest occupied unit type in the submarket. So we're happy to have a bunch of those. The submarket itself, as I mentioned, iDrive is considered one of the more blue chip areas within Orlando. The demographics, I think within 1 mile, it's 75,000 household income. Within 3 miles, it's over 100,000 average household income, which is a great rent to income ratio. Within 3 miles, the average property price to buy is 660,000. So rent versus your mortgage is actually really attractive here, which I think is really helpful with the 3 bedrooms as well. Also on the 3 bedroom, to note, there's a brand new elementary school that was built literally across the street from Patterson. And unfortunately, last year they didn't have a chance to do the boards because of COVID. So the elementary school isn't ranked yet, but it's essentially set up like a STEM school. Every student gets a laptop, and it's very tech oriented, and the teacher to student ratio is quite strong. So by all accounts, it should be as good or better than any other elementary school in the market. We'll be able to provide a direct walking path from our property to the elementary school, which will be roughly 200 feet door to door. So that's very attractive as well. I can go to the next slide. These are the financial metrics. We're acquiring the property at $280,000 a key, which, when you, for lack of a better word, right size that based upon the fact that half the units are 3 bedrooms, in our opinion, represents a discount to recent sales comps for properties that have 5 or 10% 3 bedrooms. We also think that this is far below replacement cost. There's a few other unique things about the property we talked about. All the 3 bedrooms have 3 baths. The sheer size of the amenity space. The property is also 50% less dense than properties being built today. So you have more resort feel to the property. That's also what allows for parking, which we can also repurpose as individual garages and covered parking, which command additional income. Let's see. The IRR that we're assuming here is 24.7% at a property level and 21.3% at a investor level. I think it's important to note here, in my opinion, this is a core, marginally core plus property in a core location. These returns are certainly value add. This is a really rare dynamic that we see, that we just never see, which is part of why we're so excited about this. And to answer a question I'm sure we'll be asked of, how do we get it at this price? It's a broker we know well. We've made numerous offers on other properties that they brought to market. We've come in second and third on a few. In our conversations with them, we asked what they had coming up next. This was a property that they had just gotten. The owner said for the right price, there was an opportunity to preempt. Underwrote it. We gave them an offer for their asking price within 24 hours. And put a very sizable amount of money hard, $8 million, which is borderline. It was their demand on us. Essentially, they wanted to make sure that if they didn't take it to market, knowing they full well could get a higher price, that they had absolute certainty of closing. And so we agreed to those terms, which were very, very aggressive, and that's what allowed us to secure the property at the price that we did. So one thing, if you want to stop here for a second, Andrew, one thing that I think there is to note here, this property was used for the internship program, but it wasn't occupied like normal multifamily. These properties weren't occupied 95% of the time year round. They were occupied much less, and you can tell from the use. It's a 2008 property, but when I walked in and looked at these appliances in person and actually opened up the fridge and things like that, I thought they were installed within the last year, but these are the original appliances. The cabinets are in fantastic condition. The property itself, wall to wall, is in outstanding condition. So the work that we need to do is actually very manageable. It really is from drywall in. The bones are outstanding. Probably something else worth noting here is this property has absolutely all the bones and ticks all the boxes that you would find in a 2021 property. In fact, it ticks more. So we feel that, and we budgeted for in our renovation scope, bringing this to a true 2021 spec. We allowed 16,000 per key on the interior renovations. Normally, we would probably do somewhere between 12 and 13,000. So it's a significant amount more. An example, if you're looking at this picture, we will keep the lower cabinets, replace the doors. On the upper cabinets, we'll replace those and put full height uppers, because that's what you would find in a 2021 property. So we really want to make sure that we're competing with 2021 properties. We didn't underwrite a new build rent, but we did underwrite a new build spec. So we think there is upside there. We'll also take the telephones out of the kitchens. Just notice this. Go ahead here. So this is the property as it exists now. As you can see, it is in good condition. There's a variety of upgrades that we'll do. The clubhouse is right behind this picture. We'll install a movie theater. We're going to install, because there are so many additional rooms and we're running out of amenities to put into the clubhouse, we're going to install a co-working space. Orlando is one of the biggest benefactors from work from anywhere. This property will be no exception. This submarket is no exception. And a lot of multifamily properties now are installing co-working spaces and treating that as a revenue source, charging tenants to rent that space. We'll do the same. We'll upgrade the patio furniture, create cabanas. As you can see in the background of this picture, they've already provided the trellis and structure. We'll create more kind of day beds and cabanas there. Upgrade the barbecue area. To the right is the one of 2 gym rooms that we'll have. We'll actually relocate the one on the right to the room on the left because it's larger. So that'll be the free weights and treadmills, and the one on the right will become more of a Pilates studio. You can go ahead. Next slide. So this is one of the that was one of the smaller rooms. This actually isn't the co-working space. This is what they're currently using as a business center. We haven't even decided what we're going to do with this room, if I'm being totally honest with you, because there are that many rooms. But this is one of the smaller ones. So we'll put something in there. But okay, moving on.
Lots of rent growth in the submarket. Talk a little bit about this. You know, you look at Reese or CoStar or any of the economic sources that we use to project rent growth and check supply pipeline, and you just see a tremendous amount of rent growth going forward. This, of course, shows the past couple of years, or the past year specifically, where you just had a huge spike, and it looks like it's going to continue to go into the next few years. Orlando is one of the, you know, depending on what source you use, it's one of the top 3 or top 5 markets for in-migration in the U.S. There it is.
So here are the sources and uses of the deal, the total costs. Basically, getting a loan for $85 million. We're raising $31 million directly into a deal. On deals of this size, historically, we have allocated money from our fund and then raised money from a single institution as a joint venture equity partner. As Marley alluded to earlier, one of the reasons we were able to get this deal off market was the ability for us to move extremely fast at a breakneck speed. And for that reason, the institutions, it usually takes them a couple months or a month and a half at the minimum to organize, to get their multiple layers of investment committees out to the property and approved, get the property approved. So for that reason, even though this is the largest deal we've ever bought, we're obviously syndicating this out to our individual investor base.
We'll talk a little bit about the capital stack, because I saw a few questions come in regarding the capital stack. As Andrew said earlier, it's a $31 million equity check. It's approximately 72% of total cost, $85 million loan. Sorry, I'm just looking at some questions. 72% of the total cap stack. It's a 3+1, but the extension is pretty much a free extension. It's almost a free extension. It's 10 basis points, and you don't have to meet any tests. So it's effectively a 4-year loan. So it's got minimal maturity risk. And the total capitalization is $118 million. A few people asked how much Fund 3 will be investing. Fund 3 will be investing $4 million. So as you can see here, somebody also asked what the going in cap rate is. It's north of a 5, which is unheard of in this day and age. Almost everything we see is south of a 4. So everything, right now you see trading 3 to 3.9, and this is north of a 5 going in. Then we inherit the subleases, which would be the subleases from Disney to all of the residents. And then we're expecting it to go from a 5.25 to about a 3. And then we'll work it to get it back up north of a 5. I did see somebody asked if there's rent stabilization or anything of that nature. There is not in Florida. Somebody asked about the debt. The cost of capital is LIBOR plus 295. So we'll start at about 3.1. Going in cap rate, somebody's asking what is the going in cap rate for total purchase price. It's 5.25.
5.31.
5.31. I'm not sure what it is based on total capitalization, because we're not going to be spending that money for a couple of years. And somebody else asked about expenses. There aren't any expenses because it's a triple net lease. Disney is covering all of the expenses until we take it back.
In regards to cap rates, it's worth noting that if the Disney lease wasn't in place, if this was normalized on so rents based upon market rents based upon the property as it currently exists, and what that NOI would trickle down to versus the purchase price, it's about a 4.35 cap, which we feel is about 40, maybe even 50 basis points better than the market right now.
Okay, thanks for that.
So this is basically so right now, once we take the property over, the current tenants are paying, it averages out to $1,263 after we take ownership of the property, not ownership, after we take control of the property in month 18 and we begin renovations. We think we're conservatively estimating our post renovation rents will be $2,131. So that's about over a 60% upside in the rents.
It's also worth noting that looks like a large delta from in place to post renovation. The reason why that is, the average in place is what Disney has subleased to what they have subleased to over the last few months, the multifamily tenants. And they did that at a 25 to 30% discount to market. So market rate for those units is somewhere between 15 and 1600 blended. So it's really the upgrade is the 15 to 1600 to the 2100.
So here's just a brief description of the floor plan. It's a pretty spacious units. I believe, Marley, every bedroom has its own closet. Is that correct?
Every bedroom has its own walk-in closet.
Wow. Okay.
And bathroom. You'll also see in the one bedroom, for example, on the bottom right, you see an additional storage closet there. It's just very, very spacious units.
Something I actually meant to touch on with regard to the capital stack, you probably notice on the sources and uses, there's a cash flow sweep. So we were able to work with our lender with whom we have an existing relationship to where they don't fund all the renovations through debt. And we're sweeping part of the cash flow. So we're using some of the cash flow from the first 18 months, which is effectively guaranteed cash flow because of who is on the lease, Disney. And we're sweeping that into a reserve account, and we're going to be using that with a combination of future debt to capitalize the renovations. That way we're not overcapitalizing and over leveraging the asset.
So here's just a snapshot of the sales comparisons. We obviously won't go over all of them, but Marley, is there like one or two that stand out that we could speak to?
Sorry, I was on mute. Yeah, this was one of the challenges because of the uniqueness of the property of looking at comps. But most recently, actually, to be honest with you, there's some more that have happened in the last month. The market has moved pretty significantly. You guys might have seen that earlier in the brief that Orlando rents have gone up 21% year on year, which is tremendous. So the apartments that we're seeing, the communities we're seeing coming out now are actually trading more around 320,000 a key. And I just spoke to a broker today that has another one where they were asking 330,000, and it's actually going to be closer to 350,000 a key. So just in the last, all of these were, I think the most recent one closed in June 2021, which means it was probably marketed in April, roughly, maybe March. And in that time, the rents have gone up 10 to 15% just in that time. So some of these are pretty outdated, but we feel, as you can see, at 279 a key, we're in line with the more recent trades in June. And on a price per square foot, because our units are so much larger, which doesn't even factor in the amenity space, you can see that we're actually kind of in the middle of the pack there. So we feel pretty good about that.
I can speak to a little bit on the rent comps. So I think the most important comps here to focus on, Cumberland Park is close, it's across the street. It's completely unrenovated, classic, original condition. So, if you want to see what your market rents are for something that's just untouched, that's a perfect comp to point to. Post renovation, the best comps, in my opinion, would be Urbana, Solstice, and City Lakes. Urbana is not close by, but it's a great comp because it's the only property that's got 3-bedroom, 3-bath units, and they're renting for close to $2,900. And we marked ours to $2,500. So very, very conservative. City Lakes, a little bit newer, same with Solstice. Solstice, I would say, is the highest quality product of those three. Very nice asset, amazing amenities, great units. They clearly spent a ton of money on it. Almost looks like for sale product. They've got spa facilities, golf simulators, just an amazing asset. City Lakes is what we're going to be renovating to, meaning that's spec. And I think it's a great comp. And as we go through the slides here, you'll see that our pro forma rents line up very, very well with those comps.
That was 1-bedrooms. These are 2-bedroom comps.
And then threes, you see, Solstice and City Lakes are 2661, 2725, and then Urbana, 3-bedroom, 3-bath, 2,849. So you're starting to push 3K with that unit type. And that unit type is very unique, very special. As some of you may know, here in LA, we build from the ground up, and we're building some properties specifically with that unit type. And it is significantly more expensive to build, which is why you don't see it out there. But in this day and age, with housing being so unaffordable, it's a very strong unit type because it creates a perfect roommate situation where everybody gets their own full bathroom with shower. So because this is a large deal to raise on a quick timeline, we're
we have a different waterfall in this deal than we typically have for most of our syndications. So this is more of an institutional waterfall that we're offering to our individual investors. So our typical structure is a 75-25 split with a manager catch-up that makes it a true 75-25 split. In this deal, we don't have a manager catch-up. So essentially, the first tier is a 9% preferred return to the investors. Second tier, I should have put it in here, is return of capital. Then up to a 14 IRR after a 9 pref, Tryon gets 20, the investors get 80%. Then up to a 20 IRR, the investors get 70%, Tryon gets 30%. And then if we're able to exceed a 20% investor level return, then we participate 50-50 in the profit thereafter. So it's commonly what's referred to as a tiered promote with a super promote at the end if we really outperform.
So we believe in this deal. We think it's a phenomenal deal. We do think it's going to go north of a 20. That's part of the reason why we structured it this way. So if it's below a 20 IRR, we actually make less than what we normally make when we do 75-25 after an 8 with a catch up. But in this waterfall, we're penalized if we underperform, and we're very confident in the deal. We think it'll do a 20 plus IRR. And we want everybody to be on board and know that our interests are aligned and that, we'll make money as long as everybody else makes money.
So yeah, that's.
Let's go to the chat. A lot of people have been asking questions.
Yeah,
I know I've answered.
Team, yeah, then
Okay.
I'll put our contact information. There you go. Okay, so now I know quite a few people ask questions, so let me start reading these off. There we go.
How often do we report? We report quarterly. Somebody asked about in-unit washer dryers. Yes, there will be in-unit washer dryers. There already are hookups, and we'll be putting in the washer dryers, which actually creates a phenomenal opportunity because the current washer dryer rooms can be repurposed into either a package locker system or somewhere for people to put their bikes, but there can be some sort of an amenity converted with the existing laundry rooms.
There's 3 dedicated buildings throughout the property for laundry, which will be repurposed.
Okay, then I'm going to start reading it. Or how much will the fund be investing? The fund will be investing $4 million. Can we have a breakdown of cost? That one slide with the sources of uses shows that. And we're happy. We have a pretty thorough deal brief that's laid into our PPM. We streamlined it a bit for purposes of this presentation, but anybody that wants to obviously review the PPM or the deal brief, feel free to reach out to us.
A few people have asked about Tryon co-invest. The gross co-invest will be approximately $700,000. I'm not seeing them on the screen anymore. Just come back around to you.
Can an investor do a 1031 exchange into this asset?
No, we are not taking 1031 exchange dollars.
If it is across the street from Disney, why not rent it as a luxury hotel?
It's not zoned for it. We would have to get a change of use, and that's not what we do.
Why is this asset being sold?
Because the sponsor and their equity partner out of New York are just at the end of its life. Meaning the deal's at the end of its life, so they have to sell it.
Are you seeing more work from home, which would make the 3-bedroom units more desirable where 1 bedrooms can be used as a home office?
That's definitely a possibility. We think that we're going to have a lot of demand here from families. So that'll definitely be a huge demand driver for families. That and the new elementary school across the street, which we're super excited for.
Will the cash flow be considered ordinary income on the K1? No, the cash, all distributions are not considered income, and any distributions are sheltered by depreciation because you're receiving a K1, not a 1099. The entering cap rate was 5.31. There was a link to a real deal story. I can't pull that up at the moment.
I think that just talks about.
Okay.
They bought it. Somebody.
Got it. So we're buying it from the buyer listed in that story. Disney has the net lease.
Somebody is asking about the fee structure. It's a 1-point act fee. You guys saw the promote waterfall. am I missing any fees? Property and asset management fee grossed up or however. We're not taking a property management fee the first 18 months because it's master leased and it would be egregious for us to take a property management fee. We're taking an asset management fee. So once we do take over, it's 4% gross, which is our standard, but we're going to waive 3 of that 4 in the first 18 months.
Okay, the subleases expire April 2023. Is there?
Yeah. Yeah, the subleases are your typical multifamily 10 to 12 month leases. So they'll start rolling 9 months from now, roughly.
Got it. And there's no
rent control or anything.
no rent control.
Yeah.
Got it.
Someone just asked if we're vertical. Yes, we are vertical. We're going to be property managing it. And in terms of construction, we're talking to a few groups, but we have time for that because we've got 18 months after close. So we're talking to somebody for interior design. We normally handle our own interior design, but given how massive the space is, we want a third party to put an extra set of eyes on it to help us lay it all out.
What's the next largest purchase size you've done? Earlier this year, we bought an $80 million portfolio. We're under contract on an $82 million portfolio. Single asset, I'm sorry, an $82 million deal in Denver. So this will be the biggest deal, but we've started buying some larger assets in the last 12 months. The co-invest, we already discussed that. Is the interest rate fixed for the first 3+1 years? It's
No, it's floating. LIBOR plus 295.
the expenses. What are the expenses for in year one?
There are no expenses in year one because it's triple net lease to Disney. Disney's responsible for paying all expenses.
There are a couple of small expenses, like below the line, we'll have an asset management fee, and then we'll have to put on property insurance also. So the only thing that Disney actually is not responsible for is property level insurance. They pay for the GL, we pay for property.
Got it. So we're raising 31 million. So on this deal, because it had such a tight timeline, we shared it to some of our institutional investors. They couldn't mobilize quick enough. Then we had a catch-up call with CrowdStreet, the crowdfunding platform, and talked about the deal at a high level. And they essentially the same day said they could raise the entire equity amount off of an email because of the nature of the deal. So we have given them $20 million to raise, and then we ourselves are raising $11 million, our fund, which is taking 4 of that. Is the lender requiring the current deposit of cash reserves for future CapEx work and operating expenses once the master lease goes away?
CapEx only, as I mentioned earlier, part of that sweep will be for CapEx.
Have we considered a condo conversion as an exit strategy?
No,
Why not?
we don't do for sale. That's on our business. And I would imagine there probably isn't enough profit to go through that.
Year one projections show 321,000 K in expenses. What are these if not covered by Disney?
That's probably a combination of fees and insurance.
Okay. How does the projected projected 8.65 cash on cash yield translate to investor distributions, or are the two disconnected?
That's the distributions. You're not going to get that out of the gates because we have the first 18 months with a cash sweep. So we should be at about 4 to 5 in the first 18 months. And then we'll have a dip down while we're renovating. And then it'll pick back up probably by the end of year 2.
Will any renovations happen prior to the Disney lease expiring in 2023?
This is a good question. What we've underwritten, we've assumed a quote unquote worst case scenario, which is that we have no access to the property until the Disney's lease ends in April 2023. Then we start renovations. Then we start increasing the rents. That said, we understand high level that Disney has said they'd be open to doing an earlier phased handover where, so in our minds, our goal will be to start taking over the units between 10 and 20 a month, depending on contractor bandwidth, to start renovating when these current leases start rolling in roughly 10 months or so. Same with the exterior, the common space. Right now, those rooms are just large vacant rooms. So there's an argument to be made that we could start sooner, but this is all conversations we need to have with Disney. But what we have underwritten is worst case scenario.
Got it. Thanks, Marlon. What will happen when Disney builds its properties in the next few years? Close by, and will they be close by and be competitive to this property?
It's already happening. They're not close by, and they're only going to be occupied by their internship programs. It's not going to be released to the market.
Got it. When will investors anticipate to begin receiving distributions?
Year one.
How are you able to?
By the way, let me, on that note, somebody, when I said it's going to be 4 to 5% being distributed out, somebody said in the chat that it says that it's going to be a 10% cash on cash in the book. That's correct, but we're sweeping 50% of the cash flow into a reserve. So of that cash flow, 50% is being swept into a reserve, which will be used for future renovations. And then if we wind up not using it, then we take it out of the reserve and give it back to the investors.
And that'll be released in month 36, I believe.
Yep.
So the average cash on cash is still is accurate. It's just a little bit lumpy based upon the sweep.
How are you able to raise so much equity in such a short time without an institutional partner? On this one specifically, we gave CrowdStreet 20 million. They're confident they can raise it extremely quickly. We're confident we can raise 11, in about 3 weeks. So yeah, it's a tight timeline.
But just for the record, we did have a couple of institutions that were very interested. They were just a bit slow. This was the catch with this deal. Part of why we got such a good price was this very tight timeline. So the institutions were just a little bit too late, but they were in on the deal if they could have moved faster.
4.65 exit cap seems too low. How did you project this in year 4?
That's easily supportable. 4.65 exit cap is very, very high. We actually blew out the cap rates. Everything right now is of comparable quality is trading at around 4 or lower. So, we figured if this was fully maximized without a dollar left of upside, it would trade at about 4.25. So we blew out the cap rates by 40 bips, which is how we look at it.
The floor plans, how often are investors informed of progress, provided updated reports? We provide quarterly reports, typically 6 to 7 weeks after the end of each quarter. They're sent out via email, and they have like a qualitative and a quantitative update. The floor plans do not show in-unit washer and dryers. What are the plans for laundry facilities?
There's washer and dryer rooms within each unit.
Yep.
Yeah, the hookups are already there. We just need to install the washers and dryers, and we budgeted for that.
Got it. How confident are you in OpEx projections given you don't have typical historicals to extrapolate from? What do you see as the biggest risks, non-macro, for this deal? New supply from Disney, question mark?
Okay, so the answer to the first one is what we ended up doing is we created a matrix of operating expenses, T12s from other publicly marketed deals that are very comparable to this one in the Orlando market, as well as Central Florida in general. And we based it upon that. We got actual quotes from insurance suppliers. We know our property staffing. So whenever possible, we got third-party quotes. So that's what went in. And then we know our staffing. So a majority of the OpEx, we were able to get actual numbers for what we put in there. What do you see as biggest non-macro risk for this deal?
Supply. I mean, look, you've got some supply coming online. Orlando is just one of those markets where you do see supply, but as I mentioned earlier on the call, for in-migration, it's top 3 in the country. So we're pretty comfortable and confident that the supply will absorb.
Are the buildings being wood framed any concern to you?
No.
Do you plan on sending out anticipated distribution timelines so we can see how the income sweeps will affect near-term investor cash flows and what you anticipate to distribute once the Disney lease phases out and rents increase?
Some of that should be in the deal brief. If not, email us if that's something you'd like to see. But as I mentioned earlier, it'll be 4 to 5% in year one, or I should say, through the end of the lease, which is the first 18 months. Then it will dip down, and you probably won't have any for the next couple quarters, and then it'll come back up to 6, 7 as we get past year 2 into year 3.
Disney is vacating from the building, but are they planning to rent units here in the future? No. Can you discuss fee structure, please?
We discussed that earlier.
Yeah. Are you vertically integrated? Who's the property manager, construction company, et cetera?
Discussed that too.
Will the reno start after the 18 months? Yes, potentially sooner. This is your first deal in Florida. How does the vertically integrated structure help here?
We hired, well, first of all, we've got a full staff here in the company of operations, accounting, and software. So we hired somebody in the Southeast who sits in the Miami office with me. And he's got a lot of experience. He's a seasoned operator, and he's spearheading the development of the Southeast operations team.
Tryon's relatively new to the Southeast, Florida specifically. Do you anticipate any hiccups? Well, I guess this is kind of piggybacking off that question regarding property managers, lenders, construction vendors.
No.
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 Given interest rates are scheduled to go up, how does this affect financial predictions?
We use a forward LIBOR curve in our model. That's a great question, by the way. So our model doesn't assume that our start rate is going to be flat for the entire hold period. We use a LIBOR curve that we get online, and that's what we use. So it rises over time. You could find that in the financials.
What's your minimum investment? It's $50,000 with us. Crowd Street, I believe, has their own minimum investment. I think it's lower than that at $25,000, but to come directly to us, it's $50,000. Does Crowd Street receive a different set of terms or powers? No, their investors sign the syndicate or sign the PPM just as ours do. Essentially, if you go through them, you're just going through a middleman versus coming directly to us. DSCR changes in year 3. Why?
Why does it go up? Because we have more cash flow. Year 3, we're expecting significantly more cash flow. So the DSCR goes up.
Do you have a maximum number of investors allowed? We do not.
Because we're an operator.
What are the advantages of investing directly through Tryon as opposed to Crowd Street? I mean, you get in the deal either way. It's really, you just eliminate a middleman. You get to use our investor portal versus the Crowd Street portal, which we found to be pretty cumbersome. But you get to the deal either way.
Somebody asked, how do we invest? That's a good question. You want to tell them how to go online?
Oh, yes. So the very first post in the chat is a link to request information to the deal. There it is. To request information to the deal data room. Once the way our system's set up, you'll get an email from me granting you access, and then you can review everything. And then should you want to move forward, you click a green view subscription package tab in the top right hand of the screen. Those of you who have already requested information to that data room will get an email at the conclusion of this webinar saying, hey, you can now subscribe to the deal. So basically, we're now accepting subscriptions. The operating expenses first line in the pro forma almost doubles every year. Can you help us understand that?
What does?
The operating expense first line in the pro forma almost doubles every year. Yeah, so that's probably the first year is triple net. The second year is half triple net. And then the third year is full trip, or I'm sorry, is we take over the entire expenses of the property. So year one, Disney's paying nearly all the expenses. Year two, for half of the year, they're paying half of the expenses. Then year three, we start renovating and bringing the units up to market, but we're responsible for the full expenses of the property. You said 10% for the cash is getting swept for renovations. It'll be distributed in month 36. So the cash on cash is correct. It's just going to be a little back heavy.
Is there anything else?
Instructions.
I think I should wrap it
I
up.
think looks like we answered most of these questions. Are you allowing direct investment into the Denver deal? We are not. So typically, as we alluded to earlier, usually on deals of this size, we allocate money from our fund and then partner with an institution. The Denver deal had a much longer timeline. So on that deal, we are partnering with an institution. We had the time to get, one of our large institutional partners out and comfortable with the asset. So you can get exposure to that deal by investing in the Tryon Multifamily Fund 3, which is also investing in this deal and then has investments in a deal in North Carolina and Portland.
And then if this deal gets oversubscribed, which may happen in the next couple days, you can access it through Fund 3 as well.
Crowdfunding can attract novice investors that may cause problems later. Have you had experience with crowdfunding in the past?
Probably 10 deals.
Yeah, we haven't done any deals in probably 2 to 3 years, but
2020 was the only year we missed.
Oh, okay. So yeah.
Yeah, we've been one of the more active sponsors out there in crowdfunding. We've been doing it since the infancy of the industry in 2012, 2013. We've probably crowdfunded between 10 and 20 deals. So we're very comfortable with it. We know all the groups. Yeah.
The fund does report using a K1. Basically, all of the fund level, all of the deal level information flows through to a single K1. Then you just give that to your accountant.
Somebody asked about more questions. If you have more questions, email Andrew, alucas@tryonproperties.com.
The timing, so we're closing October 26th. We'll need documents executed and funds the week. We always get everything a week prior to closing. So I guess the 19th, if that's not on a weekend. I don't think it is. All right. Thank you very much. If you guys have any other questions, feel free to email me. We look forward to hopefully having you in this deal. And if not this deal, potentially our fund or future deals. Thank you.
Thanks, everyone.